Gold is screaming to an all time high, which is a pretty big red flag and it has nothing to do with inflation. The most recent move seems to have been catalyzed by Federal Reserve Governor Christopher Waller, who gave a speech last Friday. But the part of the speech that everyone has latched onto, that's not the part to focus on. That's not the one that actually explains what's happening here. Instead, it was something else Waller said that gets us closer to the actual truth. And it has to do with another big move being made just now, too, and that's in treasuries and global bonds. The markets are telling us something is in motion here. There's rising need to hedge, but contrary to popular perception, gold isn't actually an inflation hedge. In fact, it is a poor inflation hedge. So we need to understand what it is that, first of all, Waller said, and most of all, what it is that gold is really about. That's what we'll talk about today in the context of maybe another big move starting in the Treasury market. But Christopher Waller, Friday, speech in New York City. It was titled Thoughts on Quantitative Tightening, including remarks on the paper Quantitative Tightening Around the Globe. What have we learned? It couldn't have been a more exciting presentation in paper. But what Waller said that everyone really focused on was in his concluding remarks. He said a couple things in his conclusion. The first one, he doesn't want any more MBS in the Fed's portfolio. He doesn't think they're a good fit. MBS, especially low prepayments in this environment, a whole bunch of stuff about MBS. That's not the issue here either. Instead, it was what he said about the Fed's treasury holdings that set off this, well, mini firestorm of, oh God, what's really happening here? What he said was, second, I would like to see a shift in treasury holdings toward a larger share of shorter dated treasury securities. Prior to the global financial crisis, which was not financial, we held approximately 1/3 of our portfolio in treasury bills. Today, bills are less than 5% of our treasury holdings and less than 3% of our total securities holdings. Moving toward more treasury bills would shift the maturity structure more toward our policy rate, the overnight federal funds rate, and allow our income and expenses to rise and fall together as the FOMC increases and cuts the target range. This approach could also assist a future asset purchase program because we could let the short-term securities roll off the portfolio and not increase the balance sheet. So from that passage, people are getting a couple things out of it. First of all, he just mentioned QE, a future QE. Is the Fed now starting to think about another QE in 2024? And the other thing was what people have called a reversed operation twist. The Fed would allow its long-term bonds to roll off and buy short-term bonds. If you remember the operation twist back in 2011, which was itself a reincarnation of an earlier twist from a long time ago, back in 2011, Operation Twist wasn't really about twisting the yield curve. That's what they told the public. When you have to remember the circumstances behind all that in September 2011 when they announced Operation Twist and voted for it, the economy had been unexpectedly weak. The banking system had fallen into another liquidity problem. In fact, they were talking about bailing out the repo market. Dollar shortage around the rest of the world. Banks on the brink, just like in 2008. And let's not forget, QE number 2 had just ended a couple months before all of this took place. So the last thing the Federal Reserve wanted to do, though they did want to, was do another QE so soon after the run that had just ended had ended. In other words, they couldn't do another QE3 so quickly because that would be an admission that QE doesn't work, which would have been actually helpful. But they also knew they had to do something because the situation was getting pretty grim. What they came up with was a way to do something, which remember, in the Fed's worldview and how they operate, doing something and more so announcing that they're doing something is what monetary policy is supposed to be. Remember Haruhiko Kuroda from Japan, it's all about Peter Pan. It's about whether or not you get people to believe in that you can fly. So Operation Twist was, we don't have to admit we're doing another QE just after QE2 ended, while at the same time, we're doing something. We're going to be buying some assets. Don't worry about it. Don't ask too many questions. So in the context of Waller's speech in 2024, some alarm bells are ringing here because Operation Twist in 2011 was a way to do something without appearing to be doing something. So it's natural to wonder, especially given the passage that included a reference to the Fed doing another QE, Is that what the Fed's doing here? Are they doing something in the same way as 2011, getting prepared because there's other things going on beneath the surface that maybe the Fed is privy to that nobody else is? Is this a 2011 style scenario, a reverse operation twist just to put another spin on doing something? Well, that might be something that it sounds reasonable and understandable to think that way, but my personal opinion is that I don't think Waller was doing anything more than exactly what he said. In an ideal world, this is what our Soma portfolio would look like. We wouldn't have any MBS because MBS are cumbersome and they're not ideal for a central bank. At the same time, he would like a lot more treasury bills in the Soma portfolio. Remember why they took treasury bills out of the Soma portfolio. It goes back to 2019 as the Fed was rebuilding its bill holdings. And it led to, remember, we had all that repo problems, which the Fed never connected to collateral. But that also led to a do something that isn't QE. Remember, October of 2019, the Fed's not QE5, which was a focused purchase on only treasury bills, because the Fed didn't want to be seen doing QE back then either. They had already started cutting rates, and they really didn't want people to start panicking, especially when we had a recession scare, inversion of the yield curves, and a whole bunch of repo problems. So again, it's understandable that people would make more out of what Waller said, because every time the Fed seems to do something like this, it corresponds to less than desirable circumstances. But again, the Fed purchased treasury bills, exclusively treasury bills in QE, not QE5, but then March of 2020, they realized what a big mistake that was. And so March of 2020, during that collateral shortage period, they stopped buying bills and moved all of their QE LSAT purchases down the curve. And they have been rolling off bills, not voluntarily, they've been rolling off bills during its QT as well. So what Waller's basically saying is we're looking ahead as if we think things are going to be normal. And in an ideal environment, we'd have a lot more bills and no MBS. That's pretty much all he said. He did mention about how that would affect a future QE because the Fed could then just roll off its short-term treasury bills and use the proceeds to fund their purchases of longer-term notes, which would be part of the future QE. And the reason he brought that up is because earlier in the speech, he said, QE is no longer an unconventional program. It's just part of what we do around here. And therefore, from his perspective, if the Fed wants to manipulate the yield curve down the road, what better way to do it than to roll off bills and use those proceeds to fund purchases of long-term rates with the intent of getting long-term rates to go down. Never mind that all of this stuff is just nonsense. It doesn't work that way. From Waller's perspective, that's all he was saying. So if this is not the Fed restarting something because they're worried about the way the world is, then what else did Waller say that would actually be helpful in understanding what's going on in gold and treasury bonds? Well, part of his speech was dedicated, as the title made clear, to QT. And one of the things that people have been talking about with QT ever since the second one in 2018 and 2019, it was really the second one, not the first one. It was the first official one. The first official QT, everybody said, well, without the Federal Reserve, the Treasury market's going to blow up here, especially since deficits appear to be rising. And so part of Waller's speech that was focused on QT was, well, we aren't really expecting the Treasury market to blow up because there is a deep pool of buyers. What Waller said was, as currently categorized, the financial accounts household category includes hedge funds. The Federal Reserve Board is working to segregate hedge funds in this data set. In the interim, the board publishes separate data on the balance sheets of domestic hedge funds. That's a key point here. Using this supplemental data, I find that it is not the hedge funds that are responsible for the increase in household market share. This means the increase is driven by the other household investors, including actual households and nonprofit organizations, because that's another big part of QT. As the Fed no longer buys any long-term bonds or short-term bonds or any bonds, it's letting them roll off its balance sheet, this passive quantitative tightening. That means other people have to step up, other funds, institutions, or households to buy what the Fed isn't buying. And while people have worried that there's going to be a limit, especially with the Treasury Department issuing so much debt and the federal government going completely insane, Thus far, it hasn't been an issue. And one of the reasons it hasn't been an issue, as Waller was alluding to, is the basis trade from hedge funds. And I've talked about this before in a previous video, a couple of previous videos, what the basis trade is and what it means. But as far as officials are concerned, they hate the basis trade. They think it's a big, huge risk. And so if it's only hedge funds that are buying treasuries, that's an enormous problem, at least in their minds. But what Waller was saying is that when you look at the data, what data we do have, we find that, well, no, it isn't. It doesn't appear to be domestic hedge funds that are actually buying all these treasuries that the Fed no longer is. Instead, what he says, according to the Fed data, it is actually households that are stepping up and buying, not through hedge funds, but households themselves. Now, what I would add, and I bet Waller would too if he felt like talking more of the truth, what he would say is that overseas hedge funds is another story. Offshore hedge funds that are indeed engaged in the basis trade. But the overall point remains regardless. There is demand for treasuries independent of hedge funds and the basis trade. Let's go back to Waller one more time. What do I make of this finding? My interpretation is that it reinforces the view that the demand for U.S. Treasury securities is broad and deep. The buyers are not a narrow set of deep-pocketed, sophisticated investors, but rather the American public. As a result, the pace of runoff is not a problem. As I've said and pointed out all numerous times, rates are, despite the huge issuance in treasuries, rates are actually a little bit lower than they were at the end of 2022, despite another bunch of Fed rate hikes in between and quantitative tightening. There is demand for treasuries. So all that's well and good, but it should cause everyone to ask the next logical and obvious question. Why is demand for treasuries so broad and deep? That's the part that we need to think about. Waller is basically saying there's seemingly an endless demand for safety and liquidity, which you would then think that people would realize, why is there a demand for safety and liquidity? If we're heading into a soft landing, or if we're heading into an inflationary environment, the last thing that's going to be in demand is safety and liquidity. But we see time and again demand for safety and liquidity in the form of government bonds, but also in the form of safety, that's gold. So demand for safety and liquidity in treasuries, demand for safety in gold. As far as treasuries go, treasury yields are falling back down again. In fact, the 10-year treasury today was about 4.14%, which is its lowest in over a month, which raises a couple of questions here, a couple possibilities. As we've been saying all along, after an enormous, huge, historic rally in the bond market, we expected interest rates would back up and go maybe sideways to slightly higher for a couple months. Well, it's been a couple months. And unless something substantial has changed, we do expect another leg lower in interest rates. Could we be seeing that now? And if we are, what would that mean? Well, if we do see another leg lower in treasury rates, that would mean demand for safety and liquidity. And that if there was other corroborating evidence for especially the safety part, that may make the possibility even more compelling. So let's talk about gold. Gold is commonly cited as an inflation hedge, when in truth, it is a terrible inflation hedge. That is a misconception that has developed over many years. Now, you go back to the 1970s, the Great Inflation, gold was a terrific hedge, but not against inflation. It was a hedge against, broadly speaking, some of the worst monetary and financial circumstances that just so happened to be inflationary, real inflationary. So it isn't that gold was a hedge against inflation. Gold was a hedge against gross monetary errors and incompetence. And you can see this in any number of ways. Think about the 1980s. Plot the price of gold against the CPI. The CPI vastly outperforms gold in the 1980s. Now, consumer prices were still rising at a relatively decent, unhealthy rate, but it was nothing like the Great Inflation. But still, consumer prices were rising, and gold prices were at best flat to lower, depending upon where you start your measurement. If you start measuring before the last surge in 79 and 80, gold prices were relatively flat through the 1980s, even as consumer prices rose. And that continued in the 1990s. Consumer prices, though more disinflationary, they didn't stop rising. Gold prices actually declined and got down to around $300 an ounce by the year 2000, even as consumer prices continued to move higher. So as a hedge against normal inflation or disinflationary levels of consumer prices, gold underperformed drastically. And it wasn't really until July 2005 that gold finally caught its big bid, the 21st century bid. Was that because of inflation risk, or was it because gold investors and its demand for its hedging properties understood the risks of the housing bubble? Another gross, massive monetary error, just in the opposite direction as the 1970s. Gold surged heading into the global not financial crisis. The pandemic era, the 2020s era, it behaved contrary to the popular misconception about gold being an inflation hedge. Gold surged during the pandemic and lockdowns up until August of 2020. And then once consumer prices really started to go up in 2021, gold was flat to lower. And it was flat to lower until March of 2022, got a little bit of a rally, and then sank with rising interest rates up until October of 2022. Once the yield curve really started to invert and more heavily invert, and not just the US Treasury curve, but around the rest of the world, that's when gold started to rise. Now, it looks a lot like the stock market, its behavior the last couple of years, but that's because gold corresponds to the safety bid, lower interest rates. Not only is it higher demand for safety, the opportunity cost of holding gold is safe instruments that yield something. So as the bond market and interest rates in the bond market started to level off and invert, you can see the demand for gold rise. Lower opportunity cost, but also the same demand for safety. Gold and treasuries are, in one sense, two sides of the same coin. So Christopher Waller's twist last week, the reverse twist, was really a big nothing. It's the Fed talking mechanics of an ideal portfolio. However, he did recognize that QT isn't a problem because, I wish he would recognize the next step, or maybe he does and he doesn't want to say it, demand for safety and liquidity seems to be no bottom to it. But as we've seen the big rally last year and into this year, and now gold prices reaching a record high, we have to ask, there's this bottomless demand for safety and liquidity that seems to be even more bottomless just recently. Why might that be? Demand for safety and liquidity, treasury yields go down, even as the Fed says we have no plans to cut rates. Well, maybe that's the case, but the market is moving lower anyway. Gold prices are moving higher. What would cause demand for safety and liquidity to increase over and above what it has been for all this prolonged period to begin with? And there's any number of reasons for it. That's the recession risk, the deflationary recession risk, the problems in commercial real estate may be starting to bubble up, China's real estate problems. We just talked about this yesterday with China Vanke. Any number of reasons that would explain, beyond Christopher Waller's concluding remarks, what's really happening in the marketplace. Why is there so much demand for safety and liquidity in the form of treasuries, but also safety in the form of gold? With everything from recession to real estate globally, it actually makes a lot more sense than a reverse operation twist. Money risks and money evolution? Well, I just had a good conversation with Manny Rincon-Cruz about that very topic, the crypto bubble. What's actually behind it and where the boom is in the crypto space. That's the video I've got linked below. As always, I thank you for joining me. Huge thank you, Eurodollar University members and subscribers. Until next time, take care.